Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that is currently around 8 months into one of the most aggressive Fed tightening cycles in history. Now, this is a big deal for a lot of people. It's been one of the most rapid and large rate rises in history. This is the 12-month change and the 2-year yield going back to 1963. You can see the last time we were really this overextended in terms of rate hikes, right? Rate hike expectations. You can say the 2-year yield is a proxy for that. The last time we were this elevated was 1994, making 2022 in the top decile of rate shocks, right? You can understand why a lot of investors are concerned about a recession, right? Rate shocks can trigger and lead into recessions, right? 1969, 1973, rate shock recession, 1980s, rate shock recession. Of course, this is a huge blow to investor psychology after a 13-year bull run since 2009 that investors have said the Federal Reserve is responsible for this tremendous rise in the stock market thanks to QE, quantitative easing, has been asset inflationary. That narrative combined with the Fed put narrative has been obviously a lot of the optimism throughout the last decade that the Fed would step in as soon as stocks go down, right? And that was very much the case in December 2018, where after a pretty standard tightening cycle between 2015 and 2018, as soon as the stock market collapsed around 18%, guess what happened to the rate hike cycle? It stopped, and eventually easing followed. But now the Fed has been clear that it is committed to its tightening cycle. It's committed to bring inflation down, to create a growth recession, and yet the market is still quite resilient to it. So is it really as simple as don't fight the Fed? We're going to dive into history to find out if that's true and also answer the question, is someone who's bullish on the market right now actually fighting the Fed? If you're interested in following these crazy markets with us, make sure to smash that subscribe button and also smash that like button if you enjoyed this episode. It really helps push our videos out to more people, so it is really appreciated. Now let's begin by studying a few case studies where it was actually a good idea not to fight the Fed. And we have to go back to the 1970s for that, because these are prime examples where you shouldn't have fought the Fed. You can see here between the beginning of 1969 and the end of 1969, we were in a Fed rate hike cycle. The Fed was systematically raising rates, and yet the market was moving down. In fact, the market continued to move down after the federal fund rate had peaked. We can see the same thing happened here between the beginning of 1973 and the end of 1974, where we were in a pretty aggressive tightening cycle. This is the 1-year Treasury yield, by the way. You can say it is a proxy for Fed rate hike expectations, right? It mirrors the federal funds rate. And you can see throughout this entire period, it triggered probably one of the worst bear markets in history between 1973 and 1975. The market went down, I believe, around 50% throughout this tightening cycle. This is a beautiful example of a moment where you shouldn't have fought the Federal Reserve. Now let's move on to a few case studies where it was a good idea to fight the Federal Reserve. First of all, look at this. 1978, right here, all the way to 1981. That was a very powerful bull run during a moment where the Federal Reserve was tightening monetary policy significantly. So just a decade later, you have an example of a moment where stocks rose significantly despite the Federal Reserve that was tightening monetary policy and fighting inflation. Now, you're quickly going to see where I'm going with this. There will be an explanation and a conclusion to these case studies. Let's study a few more examples. Here we have the stock market against the federal funds rate, that's in orange. And you can see here, I'm going to highlight a few periods during pretty aggressive tightening cycles. 1989, 1994 right here, 1999, and then between 2004 and 2006. These are all examples of moments where the Federal Reserve was tightening monetary policy and yet the stock market was rallying, or at least holding up well, right? And dips were buying opportunities. Same thing again in 1999. Fed tightening cycle, and the stock market was rallying. Again in 2005, Fed tightening cycle, and yet the stock market was trending higher. So what's the first conclusion we can draw from this? Not everything is black or white. It's not as simple as saying just don't fight the Fed, because we can clearly spot many examples where the market was rallying during a Fed tightening cycle. Simplistic phrases like don't fight the Fed, they do hold some truth, right? Because the Fed can be a headwind to the market when they're tightening, but it can get people very confused regarding how to navigate the market. Don't fight the Fed was a lot more true right here in January 2022, when the Fed initially announced the beginning of their tightening cycle and absolutely nothing was priced in by the market. Here we've had 8 months of the markets being completely aware of the tightening cycle and pricing it in. So in order to understand how to navigate the market and not just blindly follow don't fight the Fed, we have to look at data objectively. We have to compare it to history, find out what the true risk reward is, and whether or not we find ourselves in a situation that's similar to the 60s, the 70s, or more 2005, 1994 scenario. That was covered in this article. We took a look at the inflation and Fed tightening dynamic in a lot of detail in this video and article that we posted on Friday last week. I really think this is how we should be looking at inflation in the Fed right now. It really sheds a lot of light regarding this situation. So I do strongly recommend that you go and check that out. We wrote a complete in-depth article, and then we also made a shorter video that you can watch so that you make sure you have all the key points. So very quick, are we more in a 2006, 2007 scenario, a 1994 scenario, or are we more along the lines of what happened in the 70s with the 1973-74 bear market and 1969 bear market, where the Fed really created 30-40% drawdowns in the stock market throughout their tightening cycle, while in these case studies the market held up well. So what made the difference between those two? And I think the key answer is earnings. Earnings rose throughout this period. Here they were collapsing. So in the 70s, not only did you have the Fed that was tightening, right? So valuations were going down, market valuations were going down, but you also had earnings that were collapsing at the time. Those are the worst possible conditions for stocks to rise. Whereas in both of these examples, yes, the Fed was tightening, so valuations were going down, but earnings were going up. Earnings were strong, and so that made the stock market hold up well without creating a 40% drop in the market. Now, we studied the earnings picture in quite a lot of detail over the past couple of weeks, and from how we've taken a look at it, right? And I think we've done this in quite a unique way by looking at previous earnings booms similar to the one that we had following the COVID reopening. Well, it turns out that in all of these case studies, in the vast majority of these dots here, earnings held up well, right? And you can see the 70s right here, earnings growth was a lot more mixed. You never had a boom like the one we had during COVID. So there are without a doubt big differences with what was happening in the 70s, which means perhaps this is a lot more similar to something like what we had in 2006, where earnings held up well during the tightening cycle. And the big shock to the economy, the big shock to earnings only came 2 years after the end of the tightening cycle. So it depends on what your outlook is, right? This can be scary, and this is probably going to do a lot of damage to the economy in the future. The lagging effect of monetary policy, we think, can be devastating, and that has proven to be the case in the past. But is the Fed going to drive the market down like it did in the 70s, down 40-50%? Is that something that we are currently concerned about right now? Personally, no, right? And of course, that's our opinion. We could be completely wrong on this, and you absolutely do have to do your own research. This type of move here is not something that we're currently looking at, right? Something that would take us down to 2,600 points. A lot of people have been talking about that. Now, short-term volatility, absolutely, right? And I'll be the first to tell you that objectively, if the market does not manage to hold bullish structures objectively, you're looking at short-term downside. This level right here, 3,900 points, is incredibly important. In fact, the trend line we were initially looking at right here, I'm going to quickly show you guys. This was the initial trend line. It got broken pretty impulsively. Now, we're giving it a little bit more room. If you want to consider that a breakdown, you can definitely go ahead and do that. But after looking at the charts a little bit more, this channel seems very compelling. And I think market participants are paying attention to it. So I want to see how the market behaves here before jumping to conclusions about the short-term price action. We do potentially have a bullish setup here, as we have bullish RSI divergence, RSI making a higher low with price coming down to support. So looking at momentum indicators, the MACD, if you get a return of bullish momentum, that would be incredibly bullish. But for now, watching this level very carefully, if we break it, that is bad news for the short term, and another 10% correction from current levels down to around 3,400, and another 10% correction from that level down to 3,400 points is absolutely within the cards. So I hope you guys enjoyed this video. If you did, don't forget to leave us a like and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.